Hi everyone, Mark Lichtenfeld here, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. If you're new here, welcome to the channel and make sure you hit that subscribe button and join the 15,000 others who've already subscribed. It's absolutely free, so go ahead, click it. I'll wait. Terrific. Today, I want to start with an old expression. When someone shows you who they are, believe them. I wish I'd come across that saying when I was younger. It would have saved me a lot of heartache when it came to all kinds of past relationships, especially with former girlfriends. Politicians prove this expression all the time. They show us they're complete dirtbags, and yet we act surprised when they do another dirtbag thing. And then we vote for them anyway.
One vote for McCain. Thank you.
No, I want to vote for Obama.
Anywho, I'm not here to rail on politicians. This isn't State of the Union. That would be an overblown 2-hour video rather than the bite-sized nuggets of valuable investing information you've grown to love. So today, I'm talking about how to buy, or in some cases, not to buy stocks when the market is going down. I'll save the political cheap shots for later. Now, I mentioned last week that we are in a bear market, even if the media isn't yet classifying it as one, with 63% of NASDAQ composite stocks down more than 20%. And there's a lot of advice out there to buy the dip, especially from places like Reddit, where FOMO and HODL are thrown around more than a frisbee on college quad. But how do you know when to do so and what strategies should you use? Well, I'm glad you asked. The first thing I do when thinking about getting into a stock is look at the chart.
Look at this graph.
If it's pointing down and to the right, I am not interested. I'll keep it on my watch list, but I don't want to buy a stock that it's on its way down. I need to see that the stock has stopped falling before I put my money into it. I won't buy at the bottom, but I also greatly lower my chances of buying it too high only to watch it continue to fall. Now, this is a chart of PayPal. You can see that it's been declining since July. Now, last week, you could have had all kinds of fundamental reasons to believe that PayPal is a great stock, and maybe you're right, but the market is telling you otherwise as it has been falling for 6 months.
Here, I'm just telling you to get rid of that stock now!
Remember, when someone shows you who they are, believe them. So just look at what happened after it reported earnings. The stock fell 25% the day after reporting those earnings. PayPal dropped faster than Howard Dean's polling numbers. Now, a stock in a downtrend doesn't automatically mean a company is going to miss earnings and slide further. There are occasional surprises in the market. But generally speaking, a stock that's in a downtrend stays in a downtrend and vice versa. So, what do you do if you're interested in a stock, but it looks like that PayPal chart? Well, you have some options, like literally options. Many people think options are only for speculating, but the smart money uses options in a different way. In the case of a stock that you like that's in a downtrend, you could buy the stock but then sell covered calls. When you sell a call, it gives the buyer the right but not the obligation to buy the stock at a specific price, known as the strike price, by a certain day, known as expiration. So let's say you were looking at buying CRISPR Therapeutics. Now the chart is awful, clearly in a downtrend. But you couldn't wait to buy it, so you pick up 100 shares at $63. You could then sell the March 70 calls for $3.60. Now that means that at any time between now and March 18th, when the calls expire, the buyer can buy your stock from you at $70. If the stock's at $80, well, tough luck. You have to sell it at $70.
How much is this?
$1.19?
I'll give you a quarter.
Get the hell out of here!
Though you still made 10% on the stock plus the additional $3.60 or $360 because options contracts are in 100 share lots. So your total return, the gain plus the option premium that you kept, would be 16.8% in about 6 weeks. That's pretty darn good. But if the stock is below $70, you keep the $3.60 or $360 and you keep your stock. No one's going to buy your stock from you for $70 if it's trading below that price.
Tell him 40 and no fork.
30.
That's it! You leave and never come back!
So in this case, if the stock is below your buy price, the $3.60 per share reduces some of that pain. Now, my favorite strategy for stocks in a downtrend is to sell a naked put. Now, that sounds like something we'd be talking about in next week's Valentine's Day video, but no. A put is the opposite of a call. The call buyer has the right to buy your stock. A put buyer has the right to sell you stock at the strike price by the expiration date. Again, using CRISPR, trading at $63, you could sell the March $55 put for $3. That means the put buyer is paying you $3 or $300 per 100 shares to sell you his or her stock at $55. If the stock is above $55, they're not going to sell you their stock. If it drops below $55, they will. But remember, you collected $3 per share. So if you have to buy the stock, it's really like buying it for $52 because you're buying it at $55, but you received $3. Then you own the stock at a much lower price. If the stock never gets that low, you still make some money by keeping the $3 per share. Now, these are great strategies for handling stocks you like in a difficult market. You'll make some income, and you may end up buying your favorite stock at a much lower price. Now, I never make a move in the market without consulting my stock charts, and that includes trading options. If you want to learn more about using charts to improve your trading, just click on the link in the description. Thanks for watching State of the Market, and make sure you don't miss next week's video, which will be a special Valentine's Day themed stock market video. Now, I'm not saying it's going to get a little steamy in here, but I'm not saying it won't. Click on the subscribe button so you don't miss it. I'm Mark Lichtenfeld, and I'll see you next week.